much, Business Director Eric Ba, for that wonderful introduction. Thank y'all so much for being here tonight. I'm going to get right into it because I'm going to handle the impossible right now. What's the impossible? Talking about taxes in less than 3 hours. And I'm going to do it in 20 minutes. Y'all pray for me. So let's get going here. We're going to jump right into it. We're going to talk about tax-free retirement savings programs. So jumping right in, let's do a little bit of just a little history here for you. So why are people even concerned about tax-free retirement or, reducing their taxes? The obvious reason is obviously you don't want to pay out more money, you want to keep all your money. But the other thing here you have to realize is right now, as of this month, 2024, September 2024, the U.S. national debt is over 35.27 trillion. Can you swallow that? 35.27 trillion. Maybe that number doesn't seem big to you. Well, everybody knows a billion is a big number. A billion is 1,000 million. A trillion is 1,000 billion. So think about $35,000 billion in U.S. debt. And eventually this stuff has to get paid back. So how does the government pay back their debts? Do you think they're just going to go sell lemonade or cookies or chicken dinners? No, they're going to eventually raise taxes. It's inevitable. So you have to understand, some of the things that have contributed to this are, of course, tax cuts, stimulus programs, spending on defense. War is expensive. There's no arguing that. And of course, major spending during global events. We just came out of a major global pandemic, COVID-19. So with all of that, that's one of the major reasons that the debt is so high. And so people are like, hey, I don't think taxes are going to go down. They're probably going to go up. So people are interested in tax-free retirement for that reason. Now, this is a little history on income tax and when it started, and that's up to you if you want to read all of that. What I'm going to focus on here is our current tax rates and our highest tax rates. So look at the fact that our current tax rates right now are 10%, 12%, 22%, 24%. Notice the jump between 12% and 22%, and the jump between 24% and 32%. I don't know the exact number as to what causes those jumps, and of course that fluctuates. But understand this, I have personally experienced, my wife and I experienced jumping from the 12% tax bracket to the 22% tax bracket. And I remember it like yesterday, our tax preparer said, Mr. and Mrs. Robinson, congratulations, you've graduated to a new tax bracket. And so we thought we were getting some more money. We're used to getting our 4 figures. And instead of getting 4 figures, we almost owed 4 figures. So that was the huge reality check for us. And hey, we had to make our adjustments to do what we needed to do. Now, the other thing I want you to pay attention to here is when the tax was what is the highest tax rate in history? 94%. Imagine that. For every $1,000 you made, you only kept $60. How would that make you feel? And look at when it was that high, 1944 to 1945. If we have any history buffs or any war buffs in here, or even any, highly decorated veterans from way back in the day, you'll know what was happening back then. World War II. Very expensive war, and look how high the tax bracket was. That's something to think about, ladies and gentlemen. Now, let's get into the tax-free retirement savings programs. And so we're going to talk about various financial instruments that are taxable or not. So we got 3 different areas here. You've got your taxable, which is assets that, taxable assets in which income and or dividends are taxed in the year they are received, even if it is reinvested. So any gains are also taxed as well. So you ever heard of capital gains tax, things like that? You have your savings accounts, checking accounts, stocks, and bonds. All these monies are monies that were taxed already, meaning it's in your hands. It's already gone through being taxed. And then any growth on that money also gets taxed as well. Then you have your tax deferred bucket, your IRAs, your 401ks, your 403bs, variable annuities, fixed annuities. You may hear people say things like qualified funds. That's this area here. So your money grows without being taxed. It's tax deferred, meaning that money, you're able to deposit that money somewhere before it is taxed. And then it grows. And once you finally withdraw that money, that's when you start to deal with the tax ramifications. So imagine you put away $200,000 tax-free. it grows to $1 million. Oh ho ho ho! Where do you think your tax bracket is going to be when you withdraw that entire million, and you have to pay tax on that entire $1 million? And then, of course, you have your tax advantage plans. So tax advantaged assets are positioned for the future since they receive preferential tax treatment during accumulation and at distribution. So what happens here is these are post-tax dollars, meaning you've already been taxed for this money. It gets to be put away in an instrument that grows, and that growth is not taxed either. One of the most popular plans that people know about are the 529 college saving plans. It grows tax-free, and as long as you use it for college, you don't get taxed on it. But woe is you if you use it for something else other than college funds. And of course, the other one a lot of people are aware of are the Roth IRAs. That's a big one too. Everybody's like, oh, I have a Roth, I have a Roth. They don't even know what Roth is, or they don't even know what IRA is, but they know they have it. Then of course you have your life insurance policies, whether it's whole life or variable life or universal life, but it's policies, life insurance policies with cash values. And we're going to get to talk about some of those things. So you can think of them as three different buckets. So to simplify everything you just saw on the first page, you've got your tax now bucket, your tax deferred bucket, and your tax-free retirement bucket. So your tax now bucket is after tax money with tax growth. We talked about that already. Mutual funds, stocks, CDs, savings accounts. Then you have your tax deferred bucket, 401ks, IRAs, annuities, 403bs. Before tax money, taxed upon withdrawal. Then you have your tax-free retirement bucket, Roth IRAs, and they even have Roth 401ks, believe it or not. And then life insurance, cash value life insurance, after tax money with tax-free growth. So let's dig a little deeper. The two main ways to save for a tax-free retirement are, of course, your Roth programs and your life insurance programs. So those are the two ways. So let's break that down a little deeper. So you have your Roth programs. There are Roth IRAs and Roth 401ks. So with a Roth IRA, it's a type of individual retirement account. That's what IRA stands for. That allows for tax-free growth with withdrawals in retirement, with tax-free withdrawals during retirement time. And then, of course, there are certain limits when it comes to those Roth IRAs. Here's one of the limits. You can't be balling. You can ball, but you can't ball too hard now. So if you are a single, meaning that you file your taxes single, you're unmarried, your modified adjusted gross income, basically what you, in long terms, in fancy terms, what you make, what the government acknowledges that you make, cannot be more than $161,000. It has to be less than that. So if you're talking about saving $40,000, $50,000 a year, just looking at this, not even considering the other limitations, if you're talking about saving $40,000 a year, that's a lot to save for retirement. You're gonna have a great retirement, but you got to be making 160. If you make anything over that to think you're gonna save that, you won't be able to do it in a Roth program, that's for sure. And if you're married filing jointly, only one of you can be balling, but both of you can't be balling together because the limit is 240,000. So if she's making six figures and you're making six figures, like if you both make 150K, that's 300K together, can't do it. So that automatically disqualifies you for the Roth program. Now, with the Roth 401k, like I mentioned that, it functions similar to the 401k, but again, it's post-tax dollars that can grow tax-free. And again, there are still limitations to that. They're also very rare, but there are out there. And what's even rarer, you have some companies, everybody knows, oh, 401k, and yeah, companies match. Well, first of all, used to be a bunch of companies like this that were matching when it came to the 401k. Matching meaning I put in $50, they put in $50 with me to help me save. So it kind of doubles you up. Now with matching, a lot of companies have ceased matching, even some big oil and gas companies that, you know, the thought before was oil and gas, I have arrived. It's the money's overflowing. And even certain oil and gas companies are either limiting or completely doing away with their match programs. And then even with the Roth 401k, there are even less companies that, outside the fact that some companies don't have them, there are even less companies that have Roth 401ks and match. So that's a very rare thing to find. Now, here's the other part that I want to tell you about, because I talked about saving $40,000 a year, the Roth, right? Guess what? You can't do that. Your max amount of contribution under the age of 50 is $23,000 a year. Now, if you're over 50, you've got this additional 7,500 catch up that you can do. That'll put you at $30,500 a year if you're 50 or older. So if you're 50 and you plan to retire at 65, you want to save $1 million a year, it's going to be tight with just doing 30,000 a year. And remember, it can't be balling, it can't be more than 160,000. So, but if you're under those numbers, Roth 401k might be, a Roth IRA or 401k if your company offers it, might be a feasible opportunity for you. So that's something to think about. Now there is our life insurance programs. That's the other tax-free retirement program. So what is a life insurance retirement plan? It's a life insurance plan that is a permanent type of life insurance that builds cash value and provides a death benefit. So, yeah, and then you'll see people say LIRP or laser fund and things like that. But common life insurance retirement programs include whole life and universal life policies. And as you pay premiums into these life insurance policies, part of that premium is placed into a savings account known as the cash value. And that cash value grows year over year. Now, here are some advantages of using a life insurance program for retirement savings. There are no contribution limits. So you can be balling out your eyeballs. Guess what? You can contribute to that. So that's definitely a great place to start. If you're balling, you already passed 161,000, you're making $500,000 a year. You don't have to worry about dealing with the limits on your income. Your annual contribution is only limited by the death benefit. So what that means is you can't have a $25,000 death benefit and you're putting in $800,000. That's not how that works. No. There are still some laws around that the U.S. government has put in place, so that way, they're able to regulate you just completely bypassing taxes altogether. That's not going to happen. Now, of course, the death benefit protection is there while you are saving. And what that means is it's the ability to quickly buy money and buy time. And what that means is, think about if you were doing any other savings program that wasn't a life insurance program. You have this exact plan. You have your money set out that you're going to plan to save. You're saving $20,000 a year. You know that in 20 years, you've put away this amount of money. You factor in interest, it's supposed to grow to this amount. But in year 3, you die. No more work. So if there's no more work, there's no more money. And whatever you saved in year 3, that's all you have. And again, that's just death benefit side of it. With life insurance, of course, if you're saving in those type of areas, like if you're saving $20,000 a year in a life insurance policy, guess what? You're covered for well over 7 figures. So what you actually plan to save, you have way more than that, and that's tax-free for your family. And then, of course, here's the really cool part, is some programs also have living benefits. In the event of a chronic or critical illness or critical injury or even a terminal illness, meaning that, hey, maybe you didn't die, but a terminal illness means that the doctor said you only have about 2 years to live. Or even with chronic or critical illnesses or critical injury, I know people my age, and I'm only 37, that have had strokes and heart attacks. And guess what? They can't work like they used to. That's real. If you really think about it, you can think, I know people under 50 that have had a serious illness and they can't work the way they used to. And that's not even anything to joke or laugh about. That is very real. You also know people in the sense of critical injury that they're healthy, they eat their Wheaties in the morning, they eat their veggies and their fruits, they did everything right, but somebody messed up and clipped them with the biggest truck they had in the world. And car accidents ruin people's lives every day. And you still can't work the way you once thought you would, or the way you plan to. So these living benefits are in place to help you if you run out of time much sooner than you expected. So instead of worrying about what you were supposed to save, you now have this large death benefit that the living benefits can be calculated off of to give you some tax refunds right now to do what you need to do. Because people think health insurance is to help you when you end up in a serious injury or illness. Health insurance is to make sure the doctor bills get paid. How do your house bills get paid? That's something you have to really think about. Now, we're going to be honest here and talk about all sides of things. Let's continue with the advantages, and then we'll get with some disadvantages. So some more advantages is most life programs have easy access to accumulated funds after the first year. You know, with the other plans that are like your tax deferred plans, your 401k, you got to sign forms, you got to deal with tax penalties, this, that, and the other. Not so with life insurance programs, most of them. And then the ability to make up for past year's income contribution limits, meaning maybe you were saving small here, but you've had some serious windfalls of money. You can retroactively max out what you're supposed to do the years before in this current year. And then, of course, lifetime tax-free retirement income is possible, and you still have a death benefit. I know that sounds like have your cake and eat it too, but that's literally what it is. And that's something that we could explain to you in deeper detail. But again, I only have 20 minutes, folks. I'm trying to move as fast as I can here while still being thorough. Now, let's talk about some disadvantages of using a life insurance policy program, a life insurance program for retirement savings. A person must qualify or pass underwriting processes such as a medical exam or questionnaire to participate in most life insurance retirement programs. Remember, ladies and gentlemen, this is still life insurance, just like car insurance. Can you get car insurance on a car that's been in an accident and then be covered for that accident? No, that's not how it works. Same with life insurance. Life insurance still wants to make sure that you qualify, meaning that you're healthy enough, that you're fit enough, that there's no present dangers to your current health. That's one thing. And then the other disadvantage, especially if you don't understand numbers that well, is initial costs to maintain these programs may appear higher than other retirement programs. And that's just simply said, one of the simplest examples of that is if I'm saving, $500 a month in a 401k account, for example. Let's not even talk about pre-tax versus post-tax. But if I'm saving $500 a month in a 401k, 500 times 12, $6,000. Now, there could be market fluctuation. Let's say market does really well. We'll just look at it that way. You have 6,000 plus whatever interest you've earned. Well, yes, there are some annual fees and this, that, and the other that'll come out of that, but you'd still be in the plus for, your $6,000. Now, with a life insurance policy, you're not just dealing with just pure savings. You're also dealing with the cost of insurance. So that same $500 a month is not going to equal that $6,000. In some cases, there are ways to make it still equal that. And in the long run, you'll see when we show you deeper numbers at some point that the life insurance policy will still beat out what looks like pure savings on the 401k side. Because remember, your 401k is tied to the stock market. If you've ever had a 2007, a 2008, a 2013, a 1999, a 2000, you know for a fact that what you thought you had saved can just disappear really fast. So that's something to definitely think about. But again, something you do have to qualify for. So ladies and gentlemen, I've gone over a lot of information here. Thankfully, we have recorded it. Also, we're free to repeat this information with you one-on-one to help you understand parts of this that you may not know. But I do want to thank you personally for allowing us to share this information with you, our community. And of course, we're looking forward to seeing you again very soon. Definitely share this with people that come to your mind as you heard some of this information. And for sure, come back again so you can hear again from us. Ladies and gentlemen, I want to thank you so much for your time.